All right, guys, welcome back to the channel, Pietros Maneos Finance. And as you guys can see, I have a guest here, my friend and Seeking Alpha writer, Logan Kane. He's here visiting me in Boca Raton for a few days. And I thought it was actually a perfect time to do this video because actually last evening I had a question come in on leverage ETFs, and our friendship actually kind of started with leverage ETFs. I had messaged him on Seeking Alpha on one of his essays because there were a few writers on Seeking Alpha, Dane Van Domlin, Jonathan Cooper, Greg Hudson, and Logan Kane, who had written about leverage ETFs. So I was doing a lot of research, and we interacted, became friends from that, and here we are. So what you guys have here is my video, Leverage ETFs Made Me a Millionaire versus How to Lose Everything Trading Leverage ETFs. And this was a video that I did actually in response to the guy, Curry Grinkmeyer, the Best of Us Investors, where he was really critical of leverage ETFs. He said there was another person talking about using them positively, and he said it's like the crack cocaine, the heroin of financial markets. You absolutely shouldn't do that. And so I kind of countered it in a way with the fact that what Curry was representing is conventional wisdom, what you're going to get from CFAs, MBAs, people with their Series 7, traditional financial advisors. But when you actually go into the data, it's much different. And so I did this this video actually in August, and it's got a good amount of attention, 1,500 views, 25 likes. And so people comment, and actually there's a couple comments that came in here. This one came in last night. This one is from a little while ago. He said, is there any method or strategy to invest in leverage ETFs? And then this one came in last night. So as a buy and hold strategy, not suggested with leverage ETFs. So what I wanted to do here is to pull up Portfolio Visualizer and just to kind of show you some mind-blowing data. So you see I put in TQQQ, UPRO, and TMF. And what I did here is I ran this going back to January of 2011. The first one right here, TQQQ, then UPRO. And then I did kind of, similar to my balanced alpha or hedge fundy strategies, which is that 50-50 allocation, UPRO, TMF, rebalance quarterly. And the data here is absolutely mind-blowing. So if you look at Portfolio 1, which is TQQQ, so someone in January 2011 purchased TQQQ, $10,000, and held on through all the ups and downs from January of 2011 to December of 2021. They became a millionaire. And that's actually apropos because the title for my YouTube video is Leverage ETFs Made Me a Millionaire. And it's actually the case, as Logan knows. I run about $1.2 million in the Maneos compounding machine. And the reason I'm at 1.2, partly, not solely, but partly is my use of leverage ETFs. So, I mean, the CAGR on this is just out of bounds. I mean, 53% on TQQQ, which is otherworldly. I mean, it places you in the realm of Jim Simmons at Rentec. You look at people like Carl Icahn, David Tepper, Buffett and Munger at Berkshire. They're in the 20s. I mean, just kind of, and even the UPRO. I mean, you're at 35, and then this is the UPRO TMF 33.15. And this is Vanguard. I mean, so look, if you put in TQQQ, you a million. If you put it in VOO, you have 46,000. So it's just mind-blowing. I don't know if Logan here wants to opine on anything, just looking at this data. If you've seen this before, just some initial response to just looking at this.
I think what this data shows is that leveraged ETFs, they're not crack cocaine, they're not a scam. They're very powerful, in fact. They're powerful and they're dangerous. So what you need to know is how to use them properly. And there's a lot of theory behind this. For example, I've written a few pieces which we'll link to. The theory can be a little complicated, but they're really a function of the stock market return, of interest rates, and volatility. So ideally, for a leveraged ETF, you want low volatility, low interest rates, and high returns. And if you can connect on all of those, you can get a return like TQQQ right there that turned $10,000 into 1.1 million almost. And that's not, that this shows that that's not impossible. It's not easy. Certainly, hindsight is 2020. But I think the main point of this is that we've debunked the idea that leveraged ETFs are a scam, and that if you can figure out how to use them right, there's a lot of potential for profit here.
Very true, very true. And I would add to that, you said hindsight's not 2020. I would also add, I don't want to say this as a negative person, but it might have been the time to buy and hold leverage ETFs from 2011 to 2021. Moving forward from, the beginning of 2022 to 2032, based on where valuations are, I would be shocked if a buy and hold TQQQ strategy from January of 2022 to, let's say, January of 2032 yielded similar results. Not saying it would necessarily be a catastrophe like a lot of people say. I mean, it might be in certain periods, but it might have been the time in 2011 to do this, and now it may not be. And to that point, to answer the question specifically, about buy and hold leverage ETFs, I think the play, and for those who follow this channel know what I do in Composer and some of the strategies, my balanced alpha and all weather. For me, the play in leverage ETFs is using rebalancing with negative correlation. So not just buying TQQQ and holding, but a TQQQ may be mixed with TYA or TMF or TLT, things that are negatively correlated, and rebalancing quarterly, harvesting some gains using, again, negative correlation and rebalancing, on that. For example, this third portfolio is sort of a permutation of a hedge fundy type thing. This is a 50-50 TMF.
And for the benefit of our audience, can you explain who hedge fundy is?
Yeah, hedge fundy is a guy, I think he started, from my understanding, on maybe Bogleheads, and he's running this strategy. I believe his strategy is 55-45. Do you know, is it 55 TMF or 55 UPRO? I think it might be 55 UPRO, 40.
It's a bond stock leveraged ETF combo.
And
he, maybe a decade ago, he put a significant amount of money in leveraged ETFs, and he continued writing about it. And people could really see his strategy work in real time. And he made a ton of money doing this.
Yeah.
So his strategy is one of the more popular implementations of leveraged ETFs.
Exactly.
There's others. I've done a few pieces on Seeking Alpha of how to use leverage ETFs to make money, kind of use the theory to make money. Dane Van Domelen has done some. Greg Hudson
also. Jonathan Cooper, I think, has also written about leverage ETFs. And just, the final point. So this one isn't exactly hedge fundies, but it's similar. His is a 55-45. This one's a 50-50. And what you can see here is look at the Shortino ratio of this portfolio 3 versus the others. A higher Shortino, higher Sharp, and look at the max drawdown. See, you can see on the TQQQ, you had a max drawdown of 49%. On UPRO, you had a max drawdown of 60. With this quarterly rebalance of TMF and UPRO, your max drawdown is only 20%. I can take 60% drawdowns and 50% drawdowns, but if some people, they put in, let's say 100,000, it's now 50 or 40, they may be like, oh, this was a scam, or this doesn't work for me, and I've lost half my money, I'm out of this thing. But this is much more manageable. I mean, look at actually the drawdown of VOO, of the Vanguard Index. It's actually almost 1-for-1, almost exactly. So the drawdown was similar. You're getting a higher Sharp, higher Shortino, and your market correlation is only 0.52 versus all these are kind of like almost 1-to-1. TQQQ is a little off that, but UPRO and obviously Vanguard are 1-to-1. So that's my advice, moving forward, is using these things like rebalance and negative correlation for more buy and hold strategies, not just stock leverage ETF strategies, buy and hold. That's, again, my personal opinion. Remember, we're not financial advisors. We're just very much interested in financial markets. Logan writes often on Seeking Alpha, so we're avid investors. But that's just kind of my 2 cents and answering your question directly. And then I'll turn it over to Logan here, and he can talk about maybe some of his essays and maybe his opinion on what I just said, that using those negative correlations, hedge fundy strategies, is probably the best play on this.
Yeah, so I think we can dig a little into the theory here without going too much into the weeds. There's plenty of links into my articles and links from my articles. But let's go to the trading strategy article.
Yeah, perfect.
This is one of my most popular pieces in Seeking Alpha, and the premise is pretty simple. The premise is basically that diversification plus leverage is a better bet than picking stocks. And so we found a strategy that had beat the S&P by 16 percentage points per year since 1928. So over a very long period of time, now almost 100 years. And the main idea behind this strategy is combining leveraged ETFs or leverage with volatility targeting. The idea being you want to own leveraged ETFs when volatility is low, and you want to have more cash or bonds when volatility is high.
Mm-hmm.
So we linked to a few different things. There's this Tony Cooper guy in New Zealand. He's a math guy, and he did some very excellent research on the long run optimal rate of leverage for various markets.
Mm-hmm.
So it turns out that for most developed markets in the Western world, if you just did leverage and just sat on it, about a 2-to-1 leverage is about optimal.
Mm-hmm.
So that in itself is very interesting, because a lot of people say, oh, you use any leverage at all, you're destined to live on the street.
Mm-hmm.
So, I mean, what we found here is that that's not necessarily true. And there's some very strong strategies around this, and we can go down here.
Yeah, tell me.
I'll see if there's any. Yeah, so daily leverage about 2-to-1 going back hundreds of years.
Mm-hmm.
There's a lot of theory in this, and I won't drag you guys into the theory too much. But if we go,
trend is your friend.
Yeah, basically
200-day moving average there. Yeah.
The main idea is that you can combine leverage ETFs with well-known strategies like trend following, like volatility targeting. You can combine stocks and bonds with leveraged ETFs. I know Dane Van Domelen did a piece on combining leverage ETFs with bonds to produce market-beating returns. The idea being that you can stack the returns. And there's been some good research on that, which we can link to in the description of the video as well.
Definitely. And I've actually built a couple of strategies sort of based on Dane Van Domelen's idea. Like I have some with UPRO and BND. I think he wrote about, and I actually do daily rebalancing on some of that, where every day it's UPRO to BND 50-50. Then obviously the UPRO TMF or TLT or TYA. I have built out some of those in Composer, so that's also interesting. And the other thing to mention is percentage of your portfolio. Like I have maybe, which would be on a high end, maybe like 20% of my portfolio in like leverage strategies. And that's probably a little high. For most people, maybe having a 5%, or 2% or an 8% or 10%, maybe 10% or under, probably 5% is just right for like the more conservative, sort of average long-term investor. I wouldn't necessarily put, like, for example, all of your life savings into the hedge fundy strategy. Maybe you have, 90% in sort of vanilla index funds like VOO, and you have 10% in a 50-50, kind of a hedge fundy, my balanced alpha strategy. So that, even if it doesn't work out, you're not ruined. You're not, like I said, in the streets, right? It's something, it was more speculation. It achieved alpha. It helps you achieve a little bit of alpha. So that's my thought. I don't know if you have an opinion on like a percentage allocation to some of these ideas.
Yeah, one of the main ideas with leverage strategies is that their average return is higher than their compound return. So they benefit from having money outside of the strategy that you can reload it if you need to. If you have a strategy with a high average return, you could constantly bet on it with a small amount of your portfolio, and you could realize that return. If you have all your money in it, you're stuck with a compounded return.
Interesting. I hadn't thought of it that way. That's really fascinating. So in a way, like, let's say you had, let's say $10,000 in a strategy like this and 90,000 in VOO. So you had 100,000 portfolio. And if your VOO goes up, you could kind of like dollar cost average, or if let's say you're in that 100,000 portfolio, let's say you're dollar cost averaging 500 a month, maybe you do that 400 into VOO and $100 cost averaging into this hedge fund-esque strategy. That's also fascinating. In fact, when you run some of this stuff on Portfolio Visualizer and you add dollar cost averaging, it's just the returns, like on the TQQQ, it's 50%. I mean, we can pull it up, but when you add that in, it just amplifies returns.
Yeah, and just to be clear, we're not all in on leveraged ETFs. Our largest holdings are index funds, and followed by individual stocks. And then strategies like these are meant to supplement and
Exactly.
complement the other stuff we're doing. So, we're not like we're all in on leveraged ETFs. Let's go to the moon. But as you can see from the portfolio visualizer, and we'll go back to this.
Yeah.
Yeah, we'll go back to it.
Yeah.
I mean, 10,000 to 1,000,000. I mean, it's not necessarily going to happen every time, but I mean, this is a pretty long period of time here, so it shows that there's something there, and you can use our work as a baseline and our theories as a baseline. You can make your own conclusions with them. I guess we'll close by linking, or let's show the card counting model.
Sure. We go right here.
So here's another, and we're going to link to this in the bio. But here's one more thing that you guys can chew on. So when I was in college, I built a model that used some of the math behind card counting and applied it to leveraged ETFs, and it's been very successful. And it's a little bit of what Pietros does in his portfolio.
Mm-hmm.
So one of the things you need to successfully trade leveraged ETFs is you need to understand the theory behind them. So one of the ways you can do that, you can look at the prospectuses of the leveraged ETFs, and they have to tell you what the risks and the rewards are, the prospectus. So they'll usually have charts. But this looks at volatility, this looks at interest rates, and this looks at expected returns. And we have ways to model each one of these. The hardest is expected returns. The interest rates are the easiest, and then the volatility is in between. And that, things could change from when we film this video to when you see this. But knowing this framework will allow you to understand whether leveraged ETFs are a good buy at any given time. The main point is that when it's a bear market and volatility is really high, leveraged ETFs are not the best. When the trend is going with you, when momentum is with you, that's the time to buy leveraged ETFs.
Mm-hmm. Very interesting. Yeah, and I also think by having, like, let's say again you have that 90% VOO and 10% allocated to more aggressive leverage ETF strategies. Even within that 10%, you might want to have a couple different strategies. So for example,
Sure.
Like the hedge fundy is like 55-45. I think you also wrote an essay on Seeking Alpha where you did, if I'm not mistaken, 70% UPRO, 30% TLT rebalance quarterly.
That's reasonable.
Yeah, something like that. You could do a market timing one based on 200-day moving average, which I built a lot of these out with Composer as well. So even within your 10%, you're kind of diversified within your leverage ETF strategies, which is a good thing, I think personally. Maybe at the 10,000, you have 3 different strategies, running there. That kind of Dane Van Domelen, BND, UPRO, the 70-30, the 50-50. So you can kind of get cute with that and have a couple different ones.
One of the common criticisms of leveraged ETFs is path dependence. So what Pietros is doing here is actually very smart. What we mean by path dependence is if the market goes down a lot before it comes back up, the path the market takes to get to where it finally ends up, it matters a lot for your returns in leveraged ETFs. So by combining these different strategies, what he's able to do is to make it less path dependent and make his final return and his returns each year more consistent. And that's really what we're aiming to do here. So I hope that everybody has a lot to dig in here. There's dozens of links in the articles that we've linked to, so you can do all the research you want to do. It's quite the rabbit hole that you can go down.
Definitely. There's a lot of research, and again, and you'll see also as you get into it, you'll see like the Curry Grinkmeyers and others. Jack Bogle famously called leverage ETFs the lunatic fringe. So we're in the lunatic fringe, right?
Lunatics.
Yeah. But no, I get it. I mean, if you're a conservative, traditional Jack Bogleheads kind of investor, there's a sort of a contempt for leverage ETFs. And you'll see that as you go down these rabbit holes. And you have to make your own decision. Again, we're not financial advisors. I'm just telling you, like, I have my own capital. Actually, famously, Nassim Nicholas Taleb said something to the effect of, and I'm paraphrasing, don't tell me what you believe in, show me your portfolio. And so, as you guys know who follow me here, I have a significant amount of capital in these strategies, in my interactive brokers, and then I also have 150,000 I just added into Composer and Alpaca. So I'm eating my own cooking, as the phrase on Wall Street is. But yeah, so I think that's pretty much it for today. I'm very appreciative for Logan coming down here, hanging out for a few days, and we just figured we'd turn on the camera, let it run, and chat a little bit about leverage ETFs. So any questions for Logan or myself, feel free to put in the comments. You can find him on Seeking Alpha. All his articles, just go to Seeking Alpha, search his name, Logan Kane. You can read all of his work and his writing. So that's pretty much it for today, guys. Really appreciate you watching. Take care. Ciao. There we go.